If you're a CFP, financial advisor, or insurance broker, then it's very likely that an S corporation is not an option for you. So if you have an S corporation, or if you're thinking about moving to an S corporation, or if your CPA or tax strategist is trying to talk you into moving to an S corporation, then you absolutely need to watch this video and understand this situation so that you don't get stuck like Ryan Flesher from LPL, who got hit with taxes, penalties, and interest for doing exactly what lots of advisors out there are doing. Plenty of CPAs and tax preparers and tax advisors are still telling financial advisors to do it this way. They're still preparing returns this way. And you're the one that's going to pay the penalty for this if you don't understand it and fix it quickly. So what is the situation here? All right, I'm going to start with a quick paragraph from a Kitsy's article. And this is where this article is a great article. I'm going to link to it in the notes below. I've got two other articles here too, one from another CPA firm and one from the tax advisor. And all of these are referencing this Fleischer case. I'm not sure how you pronounce his name. But in these articles, what we have here is just a basic explanation of what the financial advisor was doing, why he's not allowed to do it according to the tax code. The tax courts have already settled this issue. So let me be clear here. This is not a matter of, hey, Brad, you're too conservative. I don't want a conservative CPA. I want someone who's going to be a real strategist and who's going to give me the high top shelf strategies. I understand that there's some risk to it, but you're too conservative and I don't want to go that route. This is not a matter of conservative versus gray area versus aggressive tax strategy. This is just flat out wrong. It's not done correctly. Now, there are some financial advisors who can do an S corporation. I'm going to explain when you can do one, when you can't, and how you can potentially split your income between the income that's not allowed to run through the S corporation and the income that is. So we're going to go through all that. Again, the links to these articles for more detail are also in the notes below, and you can read those yourself. So let's start out with this paragraph from the Kitsy's article. It is a fundamental requirement that for an individual to receive a commission for the sale of a securities product, he or she must actually be registered as a representative of a broker-dealer. And to ensure that this rule is honored, FINRA Rule 2040 states that no payment of compensation may be made to an entity at all unless the entity itself is registered as a broker-dealer as well. So the first time I came across this issue, I had a client. Actually, it was a prospective client with Raymond James, and he wanted to set up the S corporation. And I had actually, that's not the first time I was aware of this. I had already seen the Flesher case. I had seen other CPAs talking about it. And he wanted to do this, said that all of the folks in his office were doing S corporations and they were saving a ton of taxes, and he wanted to do it as well. So I sent him these articles and said, look, this just isn't right. You're not allowed to do this. It's not conservative versus gray area. This is just, you can't do it this way. And if you do, you're going to be on the hook for a ton of taxes, penalties, and interest down the road. So at the heart of this is assignment of income. You cannot earn income and then assign it to someone else for them to pay taxes. If you could, think about this. I have 3 kids and I would assign a portion of my income up to $20,000 a year, $30,000 a year. I would just take a portion of my income and I would assign it to my kids, report it on tax returns for them. They'd get standard deductions and they'd be in lower tax brackets, and I could really reduce my taxes if I could just assign some of my income to them and not have to pay taxes on myself. Well, you can't do that. The tax law says that whoever earns the income has to pay tax on the income, and that's what's happening here. The individual, so in this case, like my prospective client from Raymond James, the individual is the one who was licensed to be able to get the commission from the broker-dealer or the insurance commission. They're the ones individually who's licensed. Their LLC, which is elected to be an S corporation, is not licensed as a broker-dealer. And so LPL, Raymond James, whoever it is that you're contracting with, they aren't allowed to contract with the LLC unless it is registered as a broker-dealer. So I asked the prospective client, I said, well, can you do that? Can you get the licensing into the LLC? And based on the Kitsy's article, based on Flesher in the court case, he said that wasn't feasible. So I don't know those pieces of it necessarily, but it's very clear that getting your LLC registered as a broker dealer so that LPL or Raymond James could contract with your LLC is not feasible. The hoops that you have to jump through to do that, the cost to do that is just so astronomical apparently that it's just not feasible. So if that's the situation where you're earning commissions, you're the individual who's licensed, your LLC doesn't hold any licensing, it's not registered as a broker dealer, then this strategy is just flat out off the table for all of that income. What is happening is CPAs are doing this. I don't know if they're just uninformed or if they just don't care because they're trying to get clients and they just say, hey, look, I'll do it for you. But what they do is the 1099 comes in the individual's name. They'll put the income on Schedule C so that it doesn't immediately flag the IRS system. Because if you don't report the income, the IRS has the 1099. They're going to be looking for the income. If you don't report it, you're going to get an automatic letter. Well, they'll report the income on Schedule C, $150,000 of income. Then they'll back it back out, $150,000 of expense reported on S Corp. And then they'll report the income on the S Corp. What this does is it makes you think that it's okay because you can do this for years and not get caught because they're putting the income on your tax return and backing it back out, which means they're bypassing the computer system. And an individual, a person at the IRS is going to have to catch this. The problem is it's 100% wrong all of the time, even in other industries. It's not just financial advisors who are doing this. It's other professionals where the income's not coming to their LLC, it's coming to them personally. They're putting it on their personal return, they're backing it back out and reporting on the S Corp. And basically all they're doing is tricking the IRS computers. And if you get caught, it's going to hurt. Read the articles, read the penalties that this Flesher guy paid. It's not going to be fun when you get caught. So what are your options? Who are the financial advisors who can do this? Well, if it's insurance commission or it's this kind of broker dealer commission, then you have to get the LLC license. So you can jump through whatever the hoops are, pay whatever the cost is, and get your LLC licensed as a broker dealer. And then I think that would be allowed. The other option is if you're doing just kind of flat fee advisory work, if you don't have to have the licensing in the LLC. So if you're just doing kind of like financial plans for people and you're an RIA or you get registered as an RIA, from what I understand, it's a lot easier. The cost is a lot lower to get the LLC and the RIA in the entity. And if the entity is the one contracting with the customers or the other company, then this is allowed. You basically have to have it. Now, even just getting the 1099, like if you somehow get LPL, like you say, oh yeah, I have what now LPL and Raymond James are probably going to do their due diligence and tell you, no, we can't do that. But let's just say you got the 1099 into your name of your LLC and not your personal name. The 1099 alone is not sufficient. The contract actually has to be in the name of the LLC. So just kind of getting a 1099 done incorrectly in that case isn't going to work. Again, it's going to fool the system, and down the road you might get caught, but it's not the right way to do it because the entity actually earning the income has to be the LLC for the S corporation to work for you. And the only way, according to FINRA, for the entity to earn the income for commissions of security products or insurance is that it has to be registered as a broker-dealer. So if it's not, this is off the table. Again, if you have other advisory fees, if you're just doing consulting, if you're a registered investment advisor, and the entity can legally contract with the client to do that, and you're not going afoul of FINRA or any of your licensing requirements, then that is the path you can go. So that's why some advisors, some CFPs can do this and some can't. It just depends on the situation that you're in and how your revenue is set up. If you have both types of revenue, then you're going to have to split those. Some of your revenue, like if you're, an insurance sale, you're doing insurance sales and the commissioning has to go to you as the licensed individual and your entity is not a broker dealer, then that income would have to run over here. But if you're also doing, flat fee advising plans and you're contracting directly with clients and you're allowed to do that through the LLC, then that income could be on the S corporation. So you might even end up in a situation where you've got some of the income on a Schedule C as a sole proprietor, and you've got some on the S corporation. So those are the options. Basically, is you either in a situation kind of like an LPL or Raymond James where you're stuck with the Schedule C, and if you're doing it the other way, you need to stop. And if you're thinking about doing it the other way, just don't even open that can of worms. Don't go down that path because it's not going to end well. Again, years and years are going to go by. You're going to think that you're just fine because you've fooled the IRS computers, but it's going to catch up to you eventually. I promise it's going to catch up to you eventually. And then, because again, this is read these articles. This Flesher case is identical to what a lot of advisors are doing, and it's not even, again, it's not a gray area. It's not like, well, my situation's a little bit different. If that's your situation, that is what it is, and I'm sorry, it's off the table for you. All right, so what do you need to do? Check your contracts. Make sure your brokerage and insurer agreements are in your S corporation's name, not you personally. If the contract is with you, the IRS is going to treat that income as yours, and it's going to be subject to the SE tax. If you do have an S corporation that's legitimate, you need to make sure that you have reasonable compensation. This is classic S Corp step number one, basics. Even with the contract in the S Corp's name, you have to pay yourself a reasonable salary that matches industry norms from the S Corporation. Commissions, because commissions by law have to flow to you in those other situations we talked about, then you need to make sure those get reported on Schedule C and they're subject to self-employment tax. Advisory fees versus commissions. So again, advisory fees like an AUM or a retainer, those can be paid into your S corporation, and then you do the salary dividend strategy in the S corporations, but commissions generally cannot be. Again, Kitsy's, I think, is the best of these three articles that kind of walks through this, again, because he's a financial planner, he's a financial advisor, and understands that side of things. And so go to his article, again, linked down there below, and look at all the details here. But those advisory fees like AUM, retainer fees, those can typically be contracted and paid into your S corporation. Commissions generally can't. You're going to have to kind of split these two things together. Now, another thing, I think that the other CPA firm website talks about this. I'm not super familiar with this. This would be more probably pushing into that gray area because it has not been tested yet. I'm not sure if Kitsy's mentioned this on his website or not. I would trust him and the tax advisor before this other CPA firm, which I don't know personally, and is just kind of another article that I found where they lay out the basics and it agrees with everything that I agree with. But then they've got kind of this other piece to it that says, hey, look, some advisors will report commissions on Schedule C. They'll deduct expenses related to that. So your legitimate expenses related to those commissions will be deducted on Schedule C. And then what they do is they have their S corporation contract with them and consult back to them. And they pay a reasonable salary for that consulting agreement, and then the leftover profits become distributions in the S corporation. Now, this has not been court tested. It is a potential workaround. Again, I am not saying you should do that. That is something you could potentially look into, and that would be more on the aggressive gray area side. And again, I haven't had a client who's needed me to look into this, but that is on that other CPA website that's linked down below to wcginc.com. And I would approach that one with caution and lots of research. I wouldn't just kind of say, oh, this is the fix. Let's just get this, agreement in place, because substance over form. The IRS can also come in and say, look, this is just kind of like you're not actually doing this. You just kind of sign some papers to make it look like you're doing this, but we're going to treat this as what it really is in reality, and not just kind of what you said it is on paper. And so you got to be careful with those types of things. Contracts and the paperwork isn't a way to avoid kind of reality and what you're actually doing in real life. Hopefully you're not already doing this. Hopefully you saw this video before some CPA or tax advisor strategist who isn't paying attention or doesn't care about your ultimate kind of compliance, and all they care about is getting a fee from you and telling you that they saved you a bunch of taxes. Hopefully you caught this before that. If not, and you need to unwind an S corporation, the best thing to do is just, hey, you know the right thing to do now. Stop it. That ends your liability, right? So you've got kind of this potential liability in the past, and all of that's still there. But the best thing you can do is start doing it right today, moving forward, and that's going to, instead of continuing to do it wrong with continued potential risk and liability there of doing it wrong, you end it today. You start doing it right moving forward, and you've effectively kind of limited your liability to what's already been done. If you really want to, you could even go back and amend returns and pay the taxes and the interest on those taxes. That is something that I would recommend, but that is ultimately up to you whether or not you do that or not. If you have any other questions, feel free to leave comments, reach out to me. I'm here to help, and hopefully this has been eye-opening to you, or maybe you already knew about this, but share this. There's a lot of advisors who don't know that they're taking this risk. They don't even know that there's this huge potential tax liability that's hanging over their heads that might come due here in a couple of years whenever the IRS kind of catches what they're doing. And I want to help them avoid that. Thanks for watching.